Bonds are the better alternative, especially for soon-to-be retirees or recently retired. Okay, Pablo wants to say hello. No? Okay. This is not for not near retirees. Remember, bonds are fixed. Stocks are exponential. They grow compounded is probably the better word, compounding. If they grow, we don't know. That's the risk you're taking. As a dividend investor, which I am, I expect dividends to compound over time. Bonds don't do that. Bonds are fixed. That's just how they work. But for the near retiree or recently retired, man, bonds are simply the better alternative. No, it's just that simple. So my man Michael Leibowitz over here, this guy kicks ass, dudes. Who is he with, by the way? Is he with Real Investment Advice? Because there's another guy with Real Investment Advice. I forgot his name. Yeah, Real Investment Advice. Yeah, these guys rock. Big fan, long time, first time. I think they got a YouTube channel as well. Bonds are the better alternative, says Michael. And the first thing it says, but what about inflation, Josh? What about inflation? That's what everybody will say. We'll say, okay, well, we only have one instance of, I hate to say hyper, but high inflation. Oh boy, Growly McGee. Look, he wants his FaceTime. Look, Pablo, you got, look, his tail's wagging. There you go. So Pablo says, when I do a video, he wants to make sure everyone recognizes that Pablo is El Jefe. Pablo Escobar. Pablo Escobar. I forgot who said that. That was freaking classic. I got to get a t-shirt that says Pablo Escobar. Oh boy, you guys want to see something funny? Look at this guy. Hi, Finnegan. Finny likes to get sunshine, so he's laying out there on the porch. All right, so anyway, I forgot what I was saying now. All right, let's go back. So during inflation times, my man Michael says right here, right here, excess return stocks versus bonds, all right? I present another graph. The chart below plots the 10-year excess returns of stocks versus bonds. To calculate the excess return, we compare the prior 10-year stock and the prevailing 10-year bond, U.S. Treasuries, at the start of the 10-year period. So we'll see right here, the stocks did better, by far, predominant amount. However, right here, looks like about 1973. So in 1963 to 1973, bonds did better. And it did like that all the way until right there, looks like 83. So from 1963 to 1973, every 10 years from on, during the periods of high inflation in the good old US of A, bonds had excess returns over stocks. Doesn't mean they had positive returns, but they had better performance. Isn't that weird? Well, I mean, the numbers are right there, dude. You can look it up yourself. Excess returns in the only period of high inflation we've ever had in the good old US of A, extended high inflation. Of course, that is because of energy costs, not because of the Federal Reserve. I'll keep saying this till I'm dead blue in the face. Spending didn't cause the inflation, i.e. the Federal Reserve didn't cause the inflation, thus the Federal Reserve can't beat inflation. It's cheap energy. That's it. Nothing else. Anyway, so right here, you can see the excess returns of bonds over stocks during the only period of inflation we had in the U.S., of steady inflation or high inflation. Here's the Great Depression. Ironically, that's the exact opposite of high inflation, and bonds had better returns during the Great Depression as well. Interesting. And then we had the insanity of the aughts. So anyway, and this is right here. This is 1931. So that's the end of World War I when we had high inflation. 1920 and 21, we had maybe 1919, 1890, I can't remember. But basically the latter part, the end of World War I, we had high inflation. And look, the 10 years after that, bonds did better. Not 10 years after that, but so again, this says what happened the 10 years previous. This is 1931. From 1921 to 1931, bonds did better than stocks, even though we had high inflation. All right. Anyway, so there you go. Now, on top of that, let me show you something. Excess returns of either are cyclical. Periods of solid excess returns are often followed by periods with lower, even negative excess returns. In November 2021, the 10-year excess returns of stocks over bonds peaked at 14.21%. The second highest period in over 110 years. The odds are future excess returns pale in comparison. So here we are right there, 1959. So after the end of World War II, massive amounts of excess returns after the end of the COVID crap. Can I even say the end of it? And then we got right here. This would be right the 10 years around World War One, and so you can see the massive excess returns of stocks over bonds. Not likely to continue. All right, let's keep going. So what Michael says is, before comparing stock returns and bond yields, it's worth contemplating that a stock investor should demand a return premium versus bond yields, because stocks have more volatility and additional risks, i.e. they can go bankrupt. Now, bonds can go bankrupt too. Government bonds can. Since 1950, investors have earned an earnings risk premium of 5.53% over bonds. You can buy a 10-year Treasury, as of this writing, was at 3.95. Now the 10-year Treasury is, let's take a gander, it's like 4.1, I think. 4.054. You can buy a 10-year Treasury, we'll just say 4%. All right, so what are we expecting for stocks? Further, investor can take some credit risk, i.e. no guarantee against bankruptcy, and get a nearly 6% on investment-grade corporate bonds. Doing so would easily beat his expectation for stock returns, which are my expectations for stock returns too, because stock returns only come from two places: dividend yield and earnings growth. That's it. No, three. I always got to throw the third thing. The third thing is price attraction, or price to earnings expansion or contraction. How much people are willing to pay for $1 of future earnings. That's it. So PE expansion or contraction is completely essentially what people expect in the market. Are they freaking thinking the market's good, or think the market's bad? If they think it's bad, there's going to be PE contraction. Earnings growth year over year, well, that's a speculation, but you get a pretty good gauge of earnings growth year over year. Now the question is, where does the earnings growth year over year come from? Well, the higher cost of labor, higher cost of interest, because the bond yields are cost more for corporations, higher energy cost, all these things go into earnings growth year over year and are a negative on it without question. Now you can argue automation, well, that's fine. However, I think earnings growth year over year is going to be tough to get 6, so I'm looking at 4. 4% earnings growth year over year. Dividend yield 2%. That's it, man. So you're getting a 6% rate of return on stocks in the future. All right, and then we're getting 4% on bonds. That's a 2% earnings risk premium. If I have a 10-year, essentially a risk-free bond, a 10-year Treasury, I'm getting 4%. I could expect a 6% rate of return on stocks, and thus that's only 2% earnings risk premium, where historically it's been about 5.5. That's why you can't rely on the earnings risk premium. I mean, because if you did, you have to say stocks would give you 9.5, and I don't expect that at all. Anyway, I'm still heavily in stocks, but I do, again, as I've said for the last year, I have a Wellington. I have bonds for the first time in my life, simply because I think bonds have a better upside than stocks, at least for the shorter term, and I want to be part of that. But I still am only 52, so I want the compounding returns of dividend growth. Bonds don't give you that. Stocks do. That's why for me, I'm still heavy in stocks. If I'm nearing retirement or recently retired, I would look differently though. Wellington's fine. Wellesley's fine, but or however you want to pursue this. But man, bonds are the better alternative right now. That could change, but as we sit here today, I think they are. All right, love your thoughts. We'll see you